Welcome to the deep dive. If your feed right now feels like a collision between a falling skyscraper and, I don't know, a courtroom drama, you are definitely in the right place. Yeah, that's a good way to put it. The crypto space has been absolutely hammered.
Hammered by volatility, and it's all compounded by some very high-stakes regulatory chess games going on in the background. We know you're trying to make sense of it all, market crashes, legal decisions that could set precedents, and then some genuinely game-changing tech announcements happening all at once.
It's a lot to process.
So our mission today is pretty simple. We're diving into a comprehensive news stack from November 2025. We're going to give you the shortcut to understanding the collapse, the legal battles, and the surprising innovation that's pushing through.
The sources we've pulled together, they really paint a polarized picture for you. On one side, you have pure market anxiety.
Right, a snapshot of extreme fear dominating everything. But on the other, you have this complex reality of developers just building infrastructure while regulators are watching their every move.
We're looking at a moment where the highest volatility meets, well, potentially decade-defining legal risk.
Exactly.
Okay, let's unpack this. And we have to start at the core with Bitcoin. I mean, the market structure is flashing some serious, undeniable red warnings right now.
It really is.
The headline figures are they're brutal. They define the whole week. Bitcoin briefly dropped below $94,000 on Sunday.
And that print, its lowest level since May 6th, it's not just a small dip.
No, it feels like a systematic reset.
That's the word for it. That slide has effectively erased what was, frankly, a massive year for Bitcoin. It's wiped out its roughly 30% gain for 2025.
Gone.
Just gone. This isn't just a correction, it's a structural breakdown. And the mood reflects that. The crypto fear and greed index slid sharply to a score of 10.
10. That's deep and extreme fear.
We are firmly locked in that zone. And a score that low, it signals widespread retail panic and a pretty rapid institutional flight to safer assets.
And we saw some key technical dominoes fall, too. That break below the psychologically important $100,000 level, that wasn't just symbolic.
Not at all. It cleared a major liquidity shelf.
Which is exactly why the floor dropped out so fast once that six-figure mark was breached.
Precisely. Breaking 100K immediately opened the path toward that critical support band, right between 93 and 95,000.
So here's the key technical warning for you.
If the market loses that 93,000 band decisively, analysts are pointing toward a deeper liquidity vacuum, something closer to $89,000 or $90,000.
And on the flip side,
any attempt at a recovery is going to face absolutely stiff resistance right back at that $100,000 psychological wall.
and just to pile on the anxiety, we're seeing all this chatter about the dreaded death cross.
Yeah.
That pattern where the 50-day moving average crosses below the 200-day. It's funny, sometimes that pattern actually marks a local bottom, like a final capitulation.
It can, but regardless, it almost always brings a period of heightened volatility and just a lot of uncertainty with it.
And if we broaden the view out to the rest of the market, altcoins are getting hit even worse.
Oh, significantly worse. They've suffered disproportionately, sliding between 8 and a massive 16% just this week.
Wow.
Ether, for example, dropped about 12%. XRP was down 9%. But the real underperformer was Solana, down more than 16%.
And Solana had such a strong run earlier this year. That 16% drop really reinforces that whole idea of mean reversion, doesn't it?
It does. It suggests that the assets that flew the highest when things were good are now falling the hardest now that fear is gripping the market.
So what's behind this?
It's really a trifecta anxieties. You have Bitcoin's structural break, you have the weakness we're seeing in U.S. tech stocks, and critically, you have slowing spot ETF inflows for a second straight week.
That last point is huge. It paints a clear picture of a broader risk-off rotation. Institutions and retail are just moving away from more speculative assets.
Absolutely.
Now, if we connect this intense market anxiety to the bigger picture, the focus shifts right into the regulatory sphere. And what's fascinating here is this ongoing, incredibly high-stakes legal drama with Tornado Cash developer Roman Storm.
This is probably the most significant legal fight happening in DeFi right now. U.S. prosecutors just recently urged the court not to acquit Storm.
Even though a jury already declined to convict him on some of the money laundering charges.
Exactly. They are clearly committed to drawing a line in the sand here.
And the line they're trying to draw, that's the central conflict. Prosecutors are arguing that Tornado Cash was knowingly structured to enable sanctions evading money flows.
Meaning they see the software itself as regulated financial infrastructure,
Hmm.
and the developer as the operator.
So what is the defense arguing?
Well, the defense counters with an argument built on freedom of expression, on open source principles. They argue that Storm's work is protected under free speech laws. It is, in effect, just published code.
The idea being that developers shouldn't be liable for what users do with the code later on.
Right. They claim developers aren't liable for the independent and, yes, sometimes criminal actions of users in a decentralized system.
So if you are a developer, this has to be terrifying. This case is a potential landmark for classifying all privacy-focused DeFi tools.
It is.
Are they neutral infrastructure, protected like pure speech? Or are they regulated financial services that need compliance baked right into the open source code?
That is the core challenge. A ruling against Storm could fundamentally redefine the legal boundaries around on-chain anonymity. It could shift all that liability onto the builders.
It would force them to embed these restrictive compliance features into their software, even if it's non-custodial and just published out there.
Every single DeFi founder is watching this case. It literally defines their potential future liability.
Okay, let's pull back from that regulatory cliff edge for a moment and bring our attention back to Ether, ETH, which, amid all this, just dipped below $3,100.
And this dip is supported by some very specific, very telling data from investment manager Timothy Peterson. He highlighted that spot ETH ETFs have seen net redemptions equal to roughly 7% of their cost basis capital over the past 5 weeks.
Okay, let's clarify that for you. Cost basis capital redemptions. That's a huge deal. This isn't just short-term traders churning assets.
No. This signals eroding conviction among the core long-term holders, the institutions that bought in early and are now taking structural losses just to get out.
And how does that compare to Bitcoin?
Well, when you compare that 7% ETH redemption against Bitcoin ETFs, which only lost about 4% of their cost basis capital in the same period.
It strengthens that narrative.
Exactly. The narrative we touched on earlier. Institutions seem to view ETH as the higher beta, higher risk leg of the trade. They're pricing it with a higher risk premium and exiting faster in a downturn.
So the technical pivot now rests firmly on that $3,000 to $3,100 band.
Absolutely. If this redemption trend keeps up, those outflows will become a major structural headwind for Ether. Every recovery rally will just face more selling pressure from investors still trying to leave.
Okay, let's shift from those structural risks to a market narrative that pops up every single time Bitcoin crashes.
I think I know where you're going with this.
The fear that Strategy, or MSTR, might be forced to liquidate its massive Bitcoin stack. We've even seen critics like Peter Schiff arguing the Strategy is heading for a death spiral.
Right, and ARCA CIO Jeff Dorman presented this really comprehensive counter-argument that frankly just dismissed those claims as stupid, inaccurate takes.
Strong words.
Very. He says the fears are grossly exaggerated and are really based on a misunderstanding of their corporate finance structure.
And Dorman had the receipts. He laid it all out. Strategy's outstanding debts do not include covenants that automatically trigger liquidation if Bitcoin price falls.
The company just isn't structured to be forced into a fire sale like that.
Plus, Michael Saylor still owns, what, about 42% of the company?
He does, which makes any kind of activist takeover trying to force a sale almost impossible. And crucially, Strategy's legacy software business is still a viable, cash-generating entity.
That cash flow helps them cover interest expenses, which reduces their default risk.
Dramatically, so the systemic risk is just overstated.
So Dorman's point is that MSTR isn't the meaningful marginal buyer of BTC it once was, not compared to the massive spot ETFs now.
Precisely. The risk of MSTR collapsing and flooding the market is simply not the systemic issue people think it is.
Okay, but this is where it gets really interesting. Shifting from that kind of systematic risk to the high cost of, well, just sheer human error.
Oh, yes.
The cautionary tale of the long-dormant Cardano whale.
This is a textbook lesson in respecting liquidity depth. It's something every single trader needs to internalize.
So what happened?
This long inactive Cardano wallet executed a massive, what we call a fat finger trade. They tried to swap a colossal 14.4 million ADA into this one highly illiquid USDA stablecoin pool.
And because that pool was so thin, it just didn't have the assets to handle a trade that big.
Right. So the transaction resulted in catastrophic slippage.
Catastrophic is the right word. That one self-inflicted error resulted in $6 million being, well, effectively burned in a single transaction.
I mean, you can almost hear the frantic keyboard mashing and then that sudden, sickening realization of the loss.
That is a historically expensive lesson in liquidity management. And it's such a shocking reminder that simple safeguards, like tightening your maximum slippage tolerance, or better yet, splitting large orders into smaller pieces.
It would have prevented that staggering loss. $6 million down the drain in a single click.
Unbelievable. All right, moving on to where the builders are focusing. Let's briefly cover the divergence in the big meme coins before we get to the structural stuff. We saw Dogecoin, DOGE, regaining a key trend line. It's printing a higher lows pattern, which suggests, continued large holder accumulation.
And in sharp contrast, Shiba Inu, SEIB, is just clinging to this fragile downtrend floor. It's showing more evidence of sustained retail selling pressure.
So even though dip buyers are active, the selling is just outweighing the conviction right now.
Yeah, in the short term, DOGE just looks relatively stronger, more technically sound.
Now, for the structural innovation that could really redefine cross-chain architecture.
Right.
Let's talk about SIG Network's Polkadot integration, which they unveiled at the Sub-Re conference.
This is a massive leap forward for interoperability. It truly is.
Explain the breakthrough.
It brings the giants Ethereum, Solana, and Bitcoin into Polkadot's native interoperability model. So instead of relying on vulnerable wrapped tokens or traditional bridges,
Which are huge hack targets.
the biggest.
Yeah.
Instead, they're using a sophisticated message translation system. It lets you do things like swap assets on Uniswap, but you get to preserve your original Polkadot identity.
So what's the core benefit of avoiding those wrapped tokens?
It all comes down to security. Traditional bridges mint these wrapped assets that are supposed to mirror the original, but those wrappers are massive single points of failure.
They're the prime target for those multi-hundred-million-dollar hacks we've seen over the last couple of years.
Exactly. SIG Network avoids that risk entirely by focusing on securely translating instructions between chains rather than moving the assets themselves.
This raises a big question then. The goal is for developers to think in flows, not bridges.
Right. It's a different way of thinking. It directly addresses today's fragmented cross-chain world by prioritizing native assets and universal contract access. It's a much safer architectural paradigm.
And finally, let's look at a new stablecoin, Palm USD, which just launched PUSD. It's pegged 1-to-1 with the US dollar. But the backing is what's interesting. It's fully held in UAE dirham and Saudi riyal, stored at Sharia-compliant institutions.
That's a huge move to tap into a very specific, globally significant capital base. But their key feature is, well, it's audacious, especially given the regulatory drama we just talked about.
Extremely audacious.
TUSD is branded as a global free currency because the protocol design explicitly ensures that wallets cannot be frozen or blacklisted.
So they're making a very strong anti-censorship statement, aiming to bridge that Sharia-compliant capital with the global digital asset economy.
That no-freeze feature is powerful, especially for capital that values privacy and censorship resistance. But you have to ask.
Considering the intense regulatory climate with the Tornado Cash, is this promise of absolute censorship resistance just a ticking time bomb?
It puts their anti-censorship ethos directly in the crosshairs of Western regulators. It absolutely does.
The tension is just. It's palpable across all these sources.
It is. The market is in extreme fear, pushing everything down. Bitcoin, Ether, altcoins. Yet this innovation continues at a rapid pace. You have safer systems like SIG Network and new stablecoins like PUSD emerging.
All while that high-stakes regulatory scrutiny, the Roman storm case, just dramatically heightens the legal stakes for every single developer out there.
Especially those working on anonymity or censorship resistance.
It's a complex and fast-moving environment. We really appreciate you joining us for this deep dive into the source material.
And here is a final provocative thought for you to explore on your own. If the court decides, as the prosecutors are urging, that developers are responsible for embedding compliance features into open source tools, the core issue in the Tornado Cash case, how long can a stablecoin like PUSD sustain its promise of a no-freeze function before it runs into similar, probably inevitable, regulatory friction?
Does the future of digital money require a mandatory kill switch? Something to think about. Until next time, stay well informed.